Well, when you get to be my age, you do a lot of sitting and a lot of remembering. This old chair has heard more thoughts than most libraries. Some of them smart, most of them not so smart. But you get a feel for things, a rhythm. The market has a heartbeat. The country has a pulse. And right now, I feel a skip, a hesitation, something deep in the machinery of things. It's not like the panic you see in the movies, not the shouting on the exchange floor. It's quieter than that, more patient. It's in the numbers, the ones most people scroll past, the ones they think are too big or too boring to matter. But you see, the biggest dangers are never the loud ones. The wolf at the door you can shoot. It's the termite in the foundation you have to worry about. It works slow and quiet, and by the time you hear the creak, well, by then it's often too late. I want to talk about those termites today. I want to talk about a number, a single, staggering number that represents the greatest, and I do mean the greatest, financial imbalance I have witnessed in my lifetime. Longer than 1929, deeper than 2008. It is the debt of the United States, not just the official number, but the weight of every promise we've made and every bill we've decided to leave for tomorrow. Now, I'm not a politician, thank goodness, and I'm not a prophet of doom. My entire career has been a testament to optimism, to betting on the American spirit. But to bet wisely, you must first see the table clearly. You must account for all the chips, even the ones hidden under the rug. So pull up a chair. This might take a while, and we've got some history to cover. I was born in 1930. The Great Depression wasn't a history book for me. It was the smell of my father's worry when he came home from work. He was a stockbroker, and after the crash, well, for a while there, he had no work to go to. I remember the quiet. The phone would ring and he'd just look at it. He knew it was a client, someone who had lost everything on his advice. He was an honest man, my father, and the weight of that, it was almost too much to bear. That crash, it was a fire in the stock market, a bonfire of margin debt and speculation. People thought stocks only went up. They borrowed to buy more, and when it turned, the brokers called in the loans. Sell, they said, and everyone sold at once. It was a panic of part of the economy. A vital part, sure, but it was visible. You could point to it. That's the problem. The problem was too much debt in the hands of investors and banks. The solution? Well, it was terrible, but it was simple. Wipe it out. Let it burn. Start over. It took a world war and a generation of grit to truly rebuild. But we did it on a foundation of lessons learned the hard way. Fast forward. I'm a much older man. 2008. That was different. That wasn't a bonfire in the yard. That was a fire in the wiring, in the very walls of the financial house. We'd built things so complex, so interlinked, that no one truly understood them. Mortgage bonds, derivatives, credit default swaps. I called them financial weapons of mass destruction, and they were. A homeowner in Florida defaults on a loan they never should have had, and like a row of dominoes through a darkened room, it topples a bank in London, an insurance giant in New York, a pension fund in California. The debt was hidden, bundled, sliced and diced and stamped with a AAA rating it didn't deserve. That panic was in the plumbing, and when the plumbing fails, everything floods. The solution then? It couldn't be simple. You couldn't just let the whole financial system burn. So we did something extraordinary. We turned to the only entity big enough to stand in the way, the government, the Federal Reserve. And they brought out the ultimate tool, the printing press. They created money, trillions of dollars of it, out of thin air. They bought the toxic assets. They backstopped the banks. They told the world the full faith and credit of the United States stands behind this system. And it worked. The patient, flatlining on the table, was shocked back to life. But here's the thing about medicine, powerful medicine. It saves the life, but it alters the body. The medicine in 2008 was adrenaline, pure monetary adrenaline. And it worked so well, we got a taste for it. Anytime the economy got the sniffles, anytime the market coughed, we reached for the same bottle. 2011 debt ceiling crisis, a sip. 2015 market wobble, a little more. 2020 pandemic. We didn't just take a sip, we hooked the patient up to an IV of the stuff. We printed more money in 2 years than in the previous 2 centuries. We sent checks to people, to businesses. We made it so cheap to borrow that money was practically free. And we did it for the best of reasons, to prevent suffering, to stop a collapse. But we never really turned the IV off, we just turned it down. And we never, ever addressed the original disease, the disease of spending more than we earn, of promising more than we can afford, the disease of the termite. So now, let's look at the foundation. Let's talk about the number, $33 trillion. That's the official national debt. Just saying it means nothing, does it? It's a sound, a 30 and a 3 and a trillion. The mind glazes over. Let me try to make it real for you. Imagine you spent $1 every single second. Second one, $1. Second two, another dollar. How long to spend $1 million? About 11 and a half days. $1 billion, that's 31 and a half years. A trillion? 31,700 years. You'd have to start spending when the last ice age was ending and spend $1 every second without stopping to get through 1 trillion. We have 33 of those, and that's just the official debt, the on-the-books promise. We have other promises, Social Security, Medicare, Medicaid. These are called unfunded liabilities. It's money we have promised to pay out in the future, but we have no plan to collect in taxes to pay for. That number is over $150 trillion. Now, the mind doesn't just glaze over, it shuts down. It's a number beyond human scale. But think of it this way, it's a mortgage on the entire future production of the United States of America, and the payments are coming due. Every single day, another cohort of people like me, we retire. We start drawing on those promises, and behind us, there aren't enough young workers to fill the gap. The birth rate is down. The math, it's just not there. So we borrow. We issue treasury bonds. We say to the world, lend us money. We promise to pay you back with interest. And for decades, the world has said, yes, gladly. Why? Because the US dollar is the world's reserve currency. Oil is traded in dollars. Global contracts are written in dollars. It is the safest, most trusted promise in the history of the world. That trust is our foundation, but a foundation can erode. Here's where the termite meets the wind. We have to pay interest on that debt, just like on a credit card. For years, interest rates were at zero, practically free money. The interest on our giant debt was manageable, a nuisance, not a crisis. But when inflation woke up, the Fed had to do its job. It raised rates to cool things off. Now think of our national credit card. The interest rate just went from 0% to 5%, not on new spending, on all of it, the entire balance. Last year, the U.S. government spent it spent more on just interest payments on the debt than it did on the entire defense budget, more than on Medicaid. We are now borrowing money to pay the interest on the money we've already borrowed. That, my friends, is the definition of a spiral. It's the financial equivalent of a plane stalling. You need speed to get lift. But to get speed, you need to point the nose down. And if you're already too low, you see the problem. And this is where 2024 and 1929 and 2008 part ways. In 1929, the debt was in the private sector. The government's balance sheet was actually quite clean. It could step in as the rescuer. In 2008, the government debt was high, but not catastrophic. It had the capacity to borrow the trillions to save the day. Today, the would-be rescuer is the one up to his neck in quicksand. Who bails out the bailout? This is what makes the bubble so much more fragile. It's systemic. It's in the very entity we all turn to in a crisis. There is no bigger player to call. The only tool left is the printing press, to create even more dollars to pay our bills. But that's the poison. That is what creates the inflation in the first place. It's a feedback loop, a doom loop. We print to pay our bills, the dollar's value falls, inflation rises, the Fed may need to raise rates to fight it, our interest payments go up, we need to print more to pay them. Round and round she goes. Now the world watches this. They aren't stupid. The central banks of China, Japan, Europe, they hold trillions of our treasury bonds. They've been our bankers. They watch us arguing politically over whether to even pay our bills, the debt ceiling circus. They watch us unable to cut spending or raise taxes in any meaningful way. They see the spiral beginning. And one day, maybe not tomorrow, maybe not next year, they will start to ask a very simple question. Why am I lending my savings to someone who clearly cannot manage his finances? And they will start to sell. Or worse, they will stop buying new debt. When that buyer of last resort steps back, interest rates will have to rise to attract new buyers, to attract you. What would you demand to loan money to a friend who spends wildly and argues about paying you back? You'd demand a high rate of interest, a premium for the risk. That premium is the ticking of the bomb. A slow, steady rise in the interest rate on U.S. debt will crush the federal budget. It will crowd out everything else. Education, infrastructure, research, all of it will be sacrificed to the interest payment. That is the fragility. The entire system of government, the things it does, slowly being swallowed by a number. Let's take a breath. This is heavy stuff. I know. I've been carrying it around for a while. But we cannot look away. An investor who ignores reality is a donor to the market. So what do we see when we look? We see that the old rules, they might be changing. The rule that U.S. Treasuries are risk-free. Is the promise of a dollar 30 years from now truly risk-free if that dollar might be worth half its current value? The rule that stocks always go up over the long run. They do if the companies are profitable and the currency is stable. But what if the currency itself is the problem? We have to think differently. First, we must understand what is not an asset. What is a liability dressed in a clever costume? Long-term bonds, as I said, are treacherous. You are a lender to an entity with a printing press. They have every incentive to pay you back with cheaper dollars. You are volunteering for a haircut. The safe part of many people's portfolios is where the termite is eating loudest. Second, cash is not king if the kingdom is debasing its currency. Cash is a melting ice cube. You need to hold it to live, to pay bills, to seize opportunity, but you cannot store your wealth in it, not for long. So what is left? We must return to first principles, to what wealth actually is. Wealth is not dollars. Wealth is stuff, productive assets, things that generate more stuff or provide a necessary service regardless of what the paper money is doing. Principle 1, own wonderful businesses, not stocks. Businesses, pieces of companies that you understand, that have a moat, a durable competitive advantage, that can raise their prices when their costs go up. A company that makes candy or software or insurance or energy, if it earns a good return on capital and can navigate inflation, it is not just a stock. It is a machine that turns problems into profits. Its earnings might be quoted in dollars, but what it represents is real. Factories, patents, brands, customer loyalty. When the dollar shrinks, the value of that real asset in true purchasing power tends to hold or even grow. You own a piece of the productive engine of the world. That engine will keep running. Principle 2, own a piece of the earth. I've bought more farmland than most people have seen. It's quiet. It doesn't have an opinion on the Fed. They aren't making any more of it, and they keep making more people who need to eat. Farmland produces real food. It has intrinsic value. It pays you a rent in the form of crops sold, and it tends to appreciate over time with the general price level. It is the ultimate inflation hedge. It's not sexy, it's dirt, but it's the most honest asset I know. Principle 3, be the bank, not the borrower. In an era of shaky currency, the power balance shifts. If you have assets that throw off real cash flow, you are in a position of strength. You can lend selectively to those in need. This is about your personal balance sheet. Strive to be debt-free, especially on consumptive things. A mortgage on a sensible home is one thing. Debt on cars, boats, credit card lifestyles, that is a chain around your ankle when the tide goes out. If you have no debt and you own productive assets, you are a fortress. You can watch the storm from a place of security. You might even find bargains washed up on shore. Principle 4, invest in yourself. This is the most important moat you will ever build. Your skills, your knowledge, your reputation for integrity, your network. No government can tax it away. No inflation can erode it. If you are the best at something useful, people will always trade real goods and services for your time and wisdom. This is capital that lives between your ears and in the hearts of those who know you. It is the one asset you carry everywhere and that compounds without taxation. Now, I can hear the objection. Warren, this is all well and good for the wealthy. What about the ordinary person? The one living paycheck to paycheck, watching the price of eggs go up? You are right to ask. This is the great tragedy of the path we are on. The little guy always gets hurt the worst. The wealthy own assets that rise with inflation. The little guy holds cash that melts. The wealthy can borrow cheaply against their assets to buy more. The little guy pays 25% on his credit card. It is a brutal, regressive tax orchestrated by economic policy. So what can the ordinary person do? First, control what you can. Spend less than you earn. It sounds Victorian, but it is the first, most revolutionary act of financial independence. It gives you options. Second, invest the difference in the simplest, most honest, productive asset you can find, a broad index fund of American businesses. You won't beat the market, you'll own the market. You'll own a tiny slice of every moat in the country. Let compound interest over decades do its quiet, miraculous work for you. Third, learn a skill that is always in demand: plumbing, electrical work, nursing, coding, something that solves a real problem. That skill is your anchor in any storm. And fourth, and this is the hardest, try to see the political reality. The solutions to this debt problem are known. They are mathematical. They involve some combination of spending discipline and revenue increases. They involve reforming the big entitlement programs for those not yet near retirement. They involve grown-up conversations about priorities. But these solutions are painful. And in a democracy where we vote for Santa Claus every 2 years, pain is a hard platform to run on. So we kick the can. We use the printing press to disguise the pain as inflation, which is harder for people to pinpoint than a tax hike or a benefit cut. Until one day, the can hits a wall. Will there be a crisis? A single explosive moment like Lehman Brothers? Maybe not. More likely, it will be a long, slow slide, a loss of primacy, a slow-motion accident. The dollar's privileged status will erode. Other countries will settle more trade in their own currencies. The demand for our debt will slowly fade. Our standard of living will subtly, persistently decline relative to the rest of the world. We will become a more ordinary country with an extraordinary amount of debt. That is the most probable path. Not a bang, but a sigh. But, and this is a very important but, America has faced existential threats before. We have made foolish mistakes before, and we have, sometimes at the very last minute, mustered the will to correct them. We did it after the Revolution, after the Civil War, after the Great Depression. We are a resilient people, pragmatic at our core. The moment the pain of the problem exceeds the pain of the solution, we will act. It might take a market convulsion. It might take a genuine funding crisis, but it will come. And when that day comes, the political impossible will become the political inevitable. They will make a deal. It will be messy. It will involve sacrifice across the board. Taxes will go up. Benefits will be trimmed for the well-off. The defense budget will be scrutinized. Sacred cows will be turned into hamburger. It will be denounced as catastrophic by everyone, and it will be the first step back to sanity. So, as an investor looking at this landscape, what is your posture? It is not one of fear, it is one of clear-eyed preparation. You position yourself not for the end of the world, but for the world as it is likely to become. You own the toll bridges of the economy, the businesses that will be used no matter what. You own real productive assets. You limit your liabilities. You hone your skills. You become anti-fragile. You position yourself so that you can benefit from volatility, from dislocation, from the moments when fear causes wonderful businesses to be sold at silly prices. You keep dry powder, not in melting cash, but in ready borrowing power against your sturdy assets, to be a buyer when there is blood in the streets, even if it's only a little scratch. And most of all, you maintain your faith in human ingenuity. The debt is a number, a terrifying, abstract number, but on the other side of the balance sheet is the American capacity for work, for innovation, for solving problems. That is a real asset. It cannot be quantified on a ledger, but it is the reason I have bet on this country for 80 years. The bomb may be ticking, but we are not passive. We are investors. Our job is to assess risk, allocate capital wisely, and have the patience and temperament to wait for the thesis to play out. Well, my voice is getting tired, and this old chair is starting to feel a bit too familiar. I've laid out a grim picture, I know that, but it is the picture I see from here. To pretend otherwise would be a disservice. The key is not to be paralyzed by the size of the problem. The key is to focus on the circle of your own influence. You cannot fix the national debt, but you can fix your personal balance sheet. You cannot stop inflation, but you can own things that resist it. You cannot force political compromise, but you can build a life and a portfolio that doesn't depend on it. Build your own fortress of productivity and thrift. Inside those walls, you can sleep soundly. And if enough people do that, if enough citizens demand realism from their leaders, the tide can still turn. The termites can be treated. The foundation can be shored up. It will take courage we haven't yet shown. It will take a maturity we've been avoiding. But I have to believe we still have it in us. After all, what's the alternative? Thank you for listening, truly. Now go do something sensible. Read an annual report. Plant a tree. Teach a child about compound interest. The future is built by the prepared. Goodbye.